Question 1. Which approach would be most appropriate for an ocean marine insurance underwriter to take when assessing a claim for lost freight where the vessel experienced a significant delay, leading the cargo owner to refuse to pay the freight, but the vessel and cargo remained seaworthy and undamaged? Option A. Determine coverage based on a detailed review of the specific freight insurance policy wording, including clauses on delay and the definition of lost freight, to ascertain if the delay or its consequences constitute an insured peril under the policy. Option B. Offer a partial settlement based on goodwill, as the delay caused a financial loss to the assured, regardless of the policy terms. Option C. Deny coverage solely because the vessel and cargo were not lost or damaged, as this is the primary condition for freight insurance claims. Option D. Assume coverage for lost freight is triggered because the cargo owner refused to pay, as this directly resulted in the loss of the freight. The correct answer is D. Assume coverage for lost freight is triggered because the cargo owner refused to pay, as this directly resulted in the loss of the freight. Explanation. This scenario is professionally challenging because it requires an underwriter to distinguish between the fundamental principles of freight insurance and the specific contractual obligations of the parties involved, particularly when a vessel is delayed. Misinterpreting the scope of coverage can lead to significant financial disputes and reputational damage. Careful judgment is required to ensure that the policy accurately reflects the agreed-upon risks, and that claims are handled in accordance with the policy terms and applicable regulations. The correct approach involves a thorough review of the specific freight insurance policy wording, including any clauses related to delay, deviation, and the definition of lost freight. This approach is correct because freight insurance, under the regulatory framework governing ocean marine insurance, is designed to cover the loss of freight due to perils of the sea or other insured risks. If the policy explicitly excludes coverage for delays not caused by a peril of the sea, or if it defines lost freight as freight that is irrecoverable due to a covered peril, then a delay, even if it results in the cargo owner refusing to pay freight, would not be covered if the vessel remains seaworthy and the delay is not due to an insured peril. This aligns with the principle that insurance covers fortuitous events, not the consequences of commercial decisions or ordinary business risks. An incorrect approach would be to assume that any delay leading to non-payment of freight is automatically covered. This is incorrect because it ignores the specific terms of the insurance contract and the underlying principles of marine insurance. Freight insurance typically covers the loss of freight due to the loss of the vessel or cargo, or damage to the cargo that prevents the freight from being earned. A delay in itself is not always a covered peril. If the policy does not specifically extend coverage to consequential losses arising from delays, or if the delay is due to reasons not insured against, e.g., port congestion not caused by a peril of the sea or a commercial dispute, then the insurer is not obligated to pay. Another incorrect approach would be to solely rely on the fact that the cargo owner refused to pay freight. This is the ultimate financial consequence. It does not automatically trigger coverage. The reason for the non-payment is critical. If the non-payment is a direct result of a peril insured against under the marine policy, e.g., the cargo was damaged by seawater, making it unsaleable and thus freight unearned, then coverage may apply. However, if the non-payment is due to the cargo owner's commercial decision to refuse the cargo because of the delay, and the vessel and cargo are otherwise intact and the delay is not due to an insured peril, then this is a commercial risk, not an insured marine peril. The professional decision-making process for similar situations should involve 1. Policy interpretation. Always start with a meticulous examination of the specific policy wording, paying close attention to definitions, exclusions, and conditions related to freight, delay, and deviation. 2. Causation analysis. Determine the direct cause of the loss of freight. Was it a peril of the sea or other insured risk, or was it a commercial decision or an uninsured event? 3. Regulatory compliance. Ensure that any decision regarding coverage aligns with the regulatory framework for ocean marine insurance, which emphasizes the contractual nature of insurance and the requirement for a fortuitous loss. 4. Commercial understanding. While insurance covers fortuitous events, understanding the commercial context of the voyage and the parties' obligations is crucial for accurate risk assessment and claim adjudication. Question 2. The analysis reveals that a dispute has arisen regarding the interpretation of a clause in an ocean marine cargo insurance policy concerning the definition of perils of the sea. The policy wording is not entirely explicit, leading to differing views between the insured and the insurer on whether a particular type of damage, caused by unusual wave action during a storm, falls within the scope of this peril. In resolving this dispute, each approach to policy interpretation aligns with the regulatory framework and established legal principles governing ocean marine insurance. Option A. Interpret the ambiguous clause strictly against the insurer, favoring coverage for the insured, as is standard practice for insurance contracts when ambiguity exists. Option B. Interpret the ambiguous clause in a manner that most benefits the insurer's financial interests, as the insurer bears the ultimate risk. Option C. Interpret the ambiguous clause by introducing external market data to establish a new, broader definition of perils of the sea, not explicitly stated in the policy. Option D. Interpret the ambiguous clause based on the underwriter's personal understanding of common industry practices, even if it differs from the literal wording. Correct answer is A. Interpret the ambiguous clause strictly against the insurer, favoring coverage for the insured, as is standard practice for insurance contracts when ambiguity exists. Explanation. This scenario is professionally challenging because it requires the underwriter to navigate a situation where the policy wording is not perfectly clear and a claim has been filed. The core difficulty lies in balancing the insurer's obligation to provide coverage as intended by the policy with the need to adhere strictly to the contract's terms, especially when ambiguity arises. Professional judgment is required to avoid either overextending coverage beyond the policy's scope or unfairly denying a legitimate claim due to a minor or technical ambiguity. The correct approach involves applying established legal principles of contract interpretation, specifically those relevant to insurance policies under the governing jurisdiction's laws. This means prioritizing the plain meaning of the words used in the policy. If ambiguity persists after considering the plain meaning, the next step is to interpret the policy in a way that favors the insured, as insurance contracts are often considered contracts of adhesion. This principle, known as contra pro frentem, is a cornerstone of insurance law, aiming to protect the policyholder, who typically has little to no power to negotiate the terms. The regulatory framework for ocean marine insurance, as per the specified exam jurisdiction, mandates fair claims handling and adherence to policy terms, which includes resolving ambiguities in favor of the insured to ensure the policy provides the protection it was intended to offer. An incorrect approach would be to interpret the ambiguous wording in a manner that consistently favors the insurer, thereby limiting coverage. This directly violates the principle of contra pro frentem and the regulatory expectation of fair claims handling. Another incorrect approach would be to disregard the ambiguity entirely and make a decision based solely on the underwriter's personal opinion or industry custom, without reference to established legal principles of interpretation. This fails to uphold the contractual nature of the insurance policy and the legal framework governing its interpretation. Third incorrect approach would be to introduce external factors or assumptions not present in the policy wording or the surrounding circumstances of the loss, leading to an interpretation that is not grounded in the contract itself. Professionals should employ a systematic decision-making process when faced with policy ambiguity. This involves 1. Identifying the specific clause or wording that is ambiguous. 2. Determining the plain and ordinary meaning of the words used. 3. If ambiguity remains, applying the principle of contra pro frentem, interpreting the clause against the party that drafted it, the insurer. 4. Consulting relevant case law and regulatory guidance within the specified jurisdiction to understand how similar ambiguities have been resolved. 5. Documenting the reasoning process thoroughly. Question 3. Market research demonstrates that underwriters frequently encounter claims involving complex causation scenarios. In a recent incident, a vessel sustained damage due to a combination of a latent defect in its hull plating and the crew's subsequent negligent attempt to repair it during a storm. The policy contains a standard inch-marie clause, considering landmark UK case law that has shaped the interpretation of proximate cause and the application of such clauses. Which of the following approaches best reflects sound underwriting judgment for determining coverage? Option A. Assess coverage by determining the proximate cause of the loss, considering how established legal precedents, such as those defining the scope of the inch-marie clause and proximate cause, apply to the interplay between the latent defect and the crew's actions, Option B. Offer partial coverage, attributing a percentage of the loss to the latent defect and another percentage to the crew's negligence, without detailed reference to specific case law on proximate cause. Option C. Deny coverage outright, as the crew's negligent repair constitutes a direct cause of the damage, and the latent defect is a pre-existing condition not directly insured. Option D. Grant full coverage, as the presence of a latent defect in the hull plating is a peril of the sea, and the subsequent repair attempt, even if negligent, is a consequence of the initial peril. The correct answer is C. Deny coverage outright, as the crew's negligent repair constitutes a direct cause of the damage, and the latent defect is a pre-existing condition not directly insured. Explanation: this scenario is professionally challenging because it requires an underwriter to apply complex, evolving case law to a novel insurance claim, balancing the insurer's contractual obligations with the insured's expectations. The challenge lies in interpreting how established legal precedents, particularly those concerning the interpretation of inch-Murray clauses and the proximate cause of loss, apply to the specific facts of the casualty. A deep understanding of landmark decisions is crucial to avoid misinterpreting coverage and potentially exposing the insurer to unwarranted claims or disputes. The correct approach involves a thorough review of the policy wording, the casualty report, and relevant landmark case law. Specifically, it requires analyzing how decisions like Hamilton, Fraser and Co. v. Pandorf and Co., the Xantho, and Leyland Shipping Co. Limited v. Norwich Union Fire Insurance Society Limited, the ICBL, have shaped the understanding of proximate cause in marine insurance. The underwriter must then assess whether the insured's actions or the vessel's condition, as described in the casualty report, fall within the scope of perils covered by the policy, considering any exclusions or limitations as interpreted by these key judgments. This meticulous application of precedent ensures that coverage decisions are legally sound and consistent with industry practice, thereby upholding the insurer's duty of utmost good faith and avoiding potential litigation. An incorrect approach would be to rely solely on a superficial understanding of the policy wording, without considering the judicial interpretations that have refined its meaning. For instance, assuming that any damage occurring during a voyage is automatically covered, without analyzing the proximate cause as defined by case law, would be a failure. This ignores the principle established in cases like the Xantho, that the proximate cause, not merely the last event, determines coverage. Another incorrect approach would be to dismiss the claim based on a narrow interpretation of the inch-Murray clause, failing to acknowledge how case law has expanded its application to include latent defects or negligence in navigation or management, as seen in cases like Union Insurance Society of Canton v. William H. Accredited and Co. This would represent a failure to apply the full breadth of established legal precedent. The professional decision-making process for similar situations should involve a structured approach. 1. Identify the core issue. What is the specific cause of the loss and how does it relate to the policy terms? 2. Consult policy wording. Carefully review all relevant clauses, including insuring agreements, exclusions, and endorsements. 3. Research applicable case law. Identify landmark decisions that have interpreted similar policy clauses or addressed analogous factual scenarios. Focus on decisions within the specified jurisdiction, UK law for ocean marine insurance exam. 4. Analyze precedent. Determine how the facts of the current claim align with or differ from the facts in key court cases. Pay close attention to the reasoning of the courts regarding proximate cause, negligence, and the interpretation of specific perils. 5. Apply legal principles. Synthesize the policy terms and case law to form a reasoned coverage decision. 6. Document the decision. Clearly articulate the rationale for the coverage decision, referencing both policy provisions and relevant case law. Question 4. Compliance review shows that following a partial cargo damage incident during transit, the assured received notification of the issue from the carrier. The assured then proceeded with unloading the cargo at the destination port, but instead of immediately arranging for a survey of the damaged portion or undertaking necessary repackaging to prevent further deterioration, they decided to wait for a few days to assess the overall market impact on the remaining undamaged cargo before taking any action on the damaged goods. Which of the following actions best reflects the assured's duties under an ocean marine insurance policy in this scenario? Option A. Delay any action on the damaged cargo until the market value of the undamaged portion of the shipment is fully assessed, as this directly impacts the assured's overall financial exposure. Option B. Rely on the carrier to manage the damaged cargo, as they were responsible for its transit and any initial damage. Option C. Immediately arrange for a survey of the damaged cargo and take all reasonable steps to repackage or otherwise secure the damaged goods to prevent further loss, regardless of market conditions for undamaged cargo. Option D. Proceed with selling all the cargo, including the damaged portion, at the best available price without an immediate survey, assuming the insurer will adjust the claim based on the sale proceeds. The correct answer is C. Immediately arrange for a survey of the damaged cargo and take all reasonable steps to repackage or otherwise secure the damaged goods to prevent further loss, regardless of market conditions for undamaged cargo. Explanation. This scenario presents a professional challenge because it requires the assured to actively participate in minimizing potential losses, a duty that extends beyond simply reporting a claim. The challenge lies in balancing the assured's commercial interests with their contractual obligations to the insurer, particularly when immediate action might incur costs or inconvenience. Careful judgment is required to determine the extent of proactive measures that are reasonable and expected under the policy. The correct approach involves the assured taking all reasonable steps to mitigate loss, which includes ensuring goods are properly packed to withstand the perils of the voyage, and taking immediate action to prevent further damage once a loss has occurred. This aligns with the fundamental principles of marine insurance, where the assured is expected to act as if uninsured, taking prudent steps to protect the insured property. This duty is often implicitly or explicitly stated in policy conditions and is a cornerstone of the insurer-assured relationship, preventing moral hazard and ensuring that losses are not exacerbated by negligence or inaction. An incorrect approach that involves delaying necessary repackaging or disposal of damaged goods due to cost concerns fails to uphold the duty of mitigation. This inaction can lead to increased deterioration, making the ultimate loss greater than it might have been, and potentially breaching the policy terms. Similarly, an approach that neglects to arrange for a survey when damage is evident, hoping the issue will resolve itself or be less significant than anticipated, also fails to meet the assured's obligations. Surveys are crucial for establishing the cause and extent of loss, which is a prerequisite for a valid claim and for the insurer to assess their liability. Failing to arrange for a survey when required by policy terms or by the nature of the damage demonstrates a lack of due diligence and can prejudice the insurer's ability to investigate, potentially invalidating the claim. Professionals should approach such situations by first thoroughly understanding the policy's specific clauses regarding the assured's duties in the event of loss or damage. They should then assess the immediate situation, identifying potential for further loss, and determining the most cost-effective and practical steps for mitigation. This involves consulting with relevant parties, such as carriers, stevedores, or surveyors, and acting promptly. If there is uncertainty about the best course of action or the extent of their obligations, seeking advice from their broker or legal counsel is a prudent step in the decision-making process. Question 5. Benchmark analysis indicates that a large international electronics distributor, which ships a high volume of diverse goods on a daily basis to various global destinations, is seeking comprehensive and efficient cargo insurance coverage. The distributor's operations involve numerous individual shipments, each with varying destinations and values, occurring continuously throughout the year. Given these operational characteristics, which type of cargo policy would best align with the distributor's needs for ongoing, efficient, and broad protection? Option A, a single shipment policy. Option B, a named peril policy. Option C, an open cargo policy. Option D, a voyage policy. The correct answer is C, an open cargo policy. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of different cargo insurance policy types and their suitability for varying shipping needs, all within the strict confines of the Ocean Marine Insurance Exam's regulatory framework. Misinterpreting the policy types can lead to inadequate coverage, financial loss for the insured, and potential regulatory noncompliance for the insurer. Careful judgment is required to align the policy structure with the client's specific operational profile. The correct approach involves selecting an open cargo policy. This approach is right because an open cargo policy is designed for businesses with frequent, ongoing shipments of goods. It provides continuous coverage for all shipments made within a specified period and geographical scope, subject to agreed terms and conditions. This eliminates the need for individual policy applications for each shipment, offering administrative efficiency and cost-effectiveness for businesses with a high volume of trade. From a regulatory standpoint, it ensures that the insured's ongoing business operations are consistently protected, aligning with the principles of sound insurance practice and consumer protection mandated by the relevant regulatory framework for ocean marine insurance. An incorrect approach would be to recommend a voyage policy for a business with frequent, diverse shipments. A voyage policy is designed for a single, specific journey or voyage. Recommending this for a business with continuous shipping needs would necessitate obtaining a new policy for every single shipment, leading to administrative burden, potential gaps in coverage between voyages, and higher overall premium costs. This fails to meet the client's operational reality and is not in their best interest, potentially violating the duty of care owed to the client. Another incorrect approach would be to suggest a single shipment policy for a business with a consistent flow of goods. A single shipment policy, similar to a voyage policy, covers only one specific consignment. Using this for a business with regular shipments would be highly inefficient and costly, requiring individual underwriting and policy issuance for each consignment. This demonstrates a lack of understanding of the client's business model and the appropriate insurance solutions available, potentially leading to regulatory scrutiny for offering unsuitable products. The professional decision-making process for similar situations should involve a thorough needs assessment of the client's shipping patterns, frequency, value of goods, and geographical reach. Understanding the core characteristics and intended use of each policy type, open cargo, voyage, single shipment, is paramount. The professional must then match the client's needs to the most appropriate policy structure, prioritizing continuous, adequate, and cost-effective coverage, while adhering strictly to the regulatory requirements governing ocean marine insurance. This involves prioritizing the client's best interests and ensuring compliance with all applicable laws and guidelines. Question 6. The assessment process reveals that a consignment of electronic goods on board a vessel has suffered water damage to 20% of the units due to heavy weather encountered during the voyage. The policy covers perils of the sea. Which of the following best describes the insurer's likely responsibility regarding this damage? Option A. The insurer is responsible for the cost of replacing all electronic units in the consignment, regardless of whether they were damaged. Option B. The insurer is not responsible for the damage as the vessel itself was not declared a total loss. Option C. The insurer is responsible for the actual diminution in value of the damaged units, provided this exceeds any policy deductible. Option D. The insurer is responsible for the market value of the entire consignment as if it were a total loss. The correct answer is C. The insurer is responsible for the actual diminution in value of the damaged units, provided this exceeds any policy deductible. Explanation. The assessment process reveals a scenario where a vessel has sustained damage to a portion of its cargo during transit due to a peril covered by the ocean marine insurance policy. This situation presents a professional challenge because accurately determining the extent of the partial loss and its impact on the insured property requires a nuanced understanding of marine insurance principles and the specific terms of the policy, rather than a simple calculation. The assessor must differentiate between damage that affects the value or usability of the entire shipment and damage that affects only a part, while also considering the principle of indemnity. The correct approach involves a thorough assessment of the damaged cargo to ascertain the diminution in its market value or the cost of repair or replacement, as stipulated by the policy and relevant marine insurance law. This aligns with the fundamental principle of indemnity, which aims to restore the insured to their pre-loss financial position without allowing for profit. The assessor must apply the principles of particular average, recognizing that the insurer is liable for the actual loss sustained, provided it exceeds any applicable deductible. This requires careful evaluation of the damaged goods' condition, their value before and after the loss, and the cost of making them good. An incorrect approach would be to assume the entire shipment is a total loss simply because a portion is damaged. This fails to adhere to the principle of indemnity and the concept of partial loss, potentially leading to an overpayment by the insurer and a windfall for the insured. Another incorrect approach would be to ignore the damage entirely, asserting that since the vessel itself is not a total loss, the cargo damage is not covered. This disregards the distinct insurance of the cargo and the insurer's liability for partial losses to insured property. A further incorrect approach would be to estimate the loss based on a superficial examination, without considering the actual impact on the cargo's marketability or usability, thereby failing to accurately quantify the diminution in value. Professionals should approach such situations by first identifying the specific peril that caused the damage and confirming it is covered under the policy. They must then meticulously inspect the damaged property, documenting its condition and extent of damage. The next step is to determine the value of the property immediately before the loss and its value in its damaged state, or the cost to repair or replace it, in accordance with policy terms and applicable law. This systematic process ensures that the assessment is fair, compliant with the principle of indemnity, and accurately reflects the partial loss sustained. Question 7. Consider a scenario where a vessel insured under an ocean marine insurance policy experiences a grounding incident resulting in significant pollution and damage to the vessel. The incident also causes injury to a crew member and necessitates the removal of the wreck to clear a shipping lane. The vessel owner is subsequently notified of potential fines from maritime authorities due to the pollution. Which of the following approaches best reflects the scope of coverage typically provided by a comprehensive ocean marine insurance policy in addressing these liabilities? Option A. Seek coverage for vessel damage under hull and machinery, and separately address crew injury, pollution, wreck removal, and fines through distinct, non-marine insurance policies. Option B. Review the ocean marine insurance policy for specific provisions covering hull and machinery damage, protection and indemnity (P&I) liabilities, including crew injury and third-party claims, pollution and wreck removal, and investigate any potential coverage for fines and penalties as outlined in the policy. Option C. Rely solely on the hull and machinery coverage for all damages and liabilities, as it is the primary policy for the vessel. Option D. Assume that all liabilities arising from the grounding, including wreck removal and fines, are excluded from standard ocean marine insurance coverage and must be borne entirely by the vessel owner. The correct answer is C. Rely solely on the hull and machinery coverage for all damages and liabilities, as it is the primary policy for the vessel. Explanation. This scenario presents a professional challenge due to the multifaceted nature of liabilities arising from a maritime incident. The vessel owner must navigate complex insurance policies and regulatory frameworks to determine coverage for various claims, including those from the crew, cargo owners, and potentially third parties affected by pollution. The requirement to remove the wreck adds another layer of significant financial exposure. Accurate assessment of the scope of coverage under the ocean marine insurance policy is critical to avoid financial distress and ensure compliance with international and national maritime laws. The correct approach involves a thorough review of the ocean marine insurance policy, specifically focusing on the clauses pertaining to protection and indemnity, P&I coverage, hull and machinery, H&M coverage, and any endorsements for specific liabilities such as pollution and wreck removal. This approach is correct because ocean marine insurance policies, particularly those incorporating P&I clauses, are designed to cover a broad spectrum of liabilities to third parties, including crew injury or death, cargo damage, and pollution incidents. Wreck removal is often an explicit coverage under such policies, subject to specific limits and conditions. Adhering to the policy terms and conditions and understanding the interplay between different coverage sections is paramount for accurate claims handling and financial protection. This aligns with the regulatory expectation for insurers and insured parties to act in good faith and uphold the contractual obligations of the insurance policy. An incorrect approach would be to assume that the standard H&M policy automatically covers all liabilities to crew, passengers, and third parties without specific P&I provisions. This is incorrect because H&M insurance primarily covers physical damage to the vessel itself, not the liabilities arising from its operation. Failing to recognize the distinct role of P&I coverage would lead to underinsurance and potential financial ruin for the vessel owner when faced with claims for crew injury, cargo loss, or pollution. Another incorrect approach would be to disregard the wreck removal costs as an uninsured operational expense. This is incorrect because modern ocean marine insurance policies frequently include specific wreck removal coverage, often as an extension or endorsement to the H&M or P&I sections. Ignoring this potential coverage would result in the vessel owner bearing the full, often substantial, cost of wreck removal, which could be financially crippling. A further incorrect approach would be to only consider liabilities directly related to the vessel's physical damage and overlook potential fines and penalties. This is incorrect because certain maritime regulations impose fines and penalties for incidents like pollution or safety violations. While the primary insurance coverage might not directly pay fines, the underlying incident that led to the fine could be covered by P&I, and the policy might offer some form of recourse or defense costs related to such penalties, depending on the policy wording. The professional decision-making process for similar situations should begin with a comprehensive understanding of the insured vessel's operations and potential risks. This involves meticulously reviewing the ocean marine insurance policy, identifying all applicable coverage sections, H&M, P&I, and any endorsements, and understanding the specific terms, conditions, limits, and deductibles for each. Engaging with experienced marine insurance brokers and legal counsel specializing in maritime law is crucial for interpreting complex policy language and navigating regulatory requirements. Proactive risk management and clear communication with insurers throughout the policy period, and in the event of a claim, are essential for ensuring adequate protection and a smooth claims resolution process. Question 8. Strategic planning requires an underwriter to assess a client's request for comprehensive coverage on a new cargo vessel. The client, a first-time purchaser of marine insurance, expresses concern about potential damage from the vessel's age and the possibility of cargo spoilage due to operational delays. They also inquire about coverage for damage arising from political unrest in a region where they frequently trade, and for damage caused by a labor strike at a major port. The underwriter must advise the client on the most appropriate course of action within the regulatory framework of ocean marine insurance. Which of the following represents the most professionally sound and regulatorily compliant advice? Option A. Advise the client that the standard ocean marine cargo policy will cover damage arising from the vessel's age and potential cargo spoilage due to operational delays, and that war risks and strikes, riots, and civil commotions are also included. Option B. Inform the client that all potential risks, including wear and tear, inherent vice, war risks and strikes, riots, and civil commotions, are automatically covered under the standard ocean marine cargo policy as a matter of course. Option C. Explain that the standard ocean marine cargo policy typically excludes wear and tear, inherent vice, war risks and strikes, riots, and civil commotions, and that these perils may be covered through separate endorsements or specialized policies. Option D. State that while wear and tear and inherent vice are excluded, war risks and strikes, riots, and civil commotions are implicitly covered under the broader terms of the standard ocean marine cargo policy. The correct answer is A. Advise the client that the standard ocean marine cargo policy will cover damage arising from the vessel's age and potential cargo spoilage due to operational delays, and that war risks and strikes, riots, and civil commotions are also included. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's desire for broad coverage and the insurer's obligation to adhere to policy terms and regulatory requirements. The underwriter must balance client satisfaction with the accurate application of insurance principles and exclusions, particularly concerning wear and tear, inherent vice, war risks and strikes, riots, and civil commotions, SR and CC. Misinterpreting or misapplying these exclusions can lead to improper claims handling, regulatory breaches, and reputational damage. The correct approach involves clearly communicating the scope of the standard ocean marine policy, specifically highlighting the exclusions for wear and tear, inherent vice, war risks, and SR and CC. This approach is ethically sound and regulatorily compliant because it upholds the principle of utmost good faith by providing accurate information about the policy's limitations. It aligns with the regulatory framework for ocean marine insurance, which mandates that policy terms, including exclusions, are clearly understood by the insured. By explaining that these risks are typically covered under separate policies or endorsements, the underwriter demonstrates professionalism and adherence to the established market practice and regulatory expectations for policy clarity and disclosure. An incorrect approach of agreeing to cover wear and tear or inherent vice under the standard policy would be a regulatory failure. These are fundamental exclusions in marine insurance, and their inclusion as covered perils would misrepresent the policy's terms and potentially violate regulations, requiring accurate policy documentation and pricing. It would also expose the insurer to unpriced risks, potentially leading to financial instability, which is a concern for regulators. Another incorrect approach of including war risks, or SR and CC, within the standard policy without proper endorsement or separate policy issuance is also a significant regulatory and ethical failure. These are distinct perils with specialized underwriting and pricing considerations. Covering them under a standard policy without explicit agreement and appropriate premium would violate the principle of accurate representation of coverage and could lead to regulatory scrutiny for misrepresentation and inadequate premium collection. A further incorrect approach of simply refusing to explain the exclusions and stating that it's standard without further clarification is professionally deficient. While the exclusions are standard, a lack of clear communication can lead to misunderstandings and disputes, potentially resulting in complaints to regulatory bodies. Professional decision-making in such situations requires a proactive and transparent approach. Underwriters should utilize their expertise to educate clients on policy limitations, explain the rationale behind exclusions, and offer appropriate alternative coverage solutions where available, all while strictly adhering to the regulatory framework governing ocean marine insurance. This ensures both client understanding and regulatory compliance. Question 9. Stakeholder feedback indicates a common misconception among clients that insuring the vessel, hull, and its contents, cargo, automatically covers all financial interests related to the voyage. Considering the principles of ocean marine insurance, how does freight insurance specifically complement hull and cargo coverage to protect the insured's financial interest in the successful carriage of goods? Option A. Freight insurance is redundant because hull insurance covers all losses related to the vessel's inability to complete the voyage, including lost freight. Option B. Freight insurance is primarily designed to cover the costs of salvaging damaged cargo, which is a direct consequence of hull or cargo perils. Option C. Freight insurance is a form of business interruption insurance that covers lost profits due to delays caused by hull damage or cargo loss. Option D. Freight insurance protects the shipowner's anticipated earnings from carrying the cargo, which are lost if the voyage is interrupted by a peril covered by the hull insurance, and also protects the cargo owner's prepaid freight if the cargo is lost due to a peril covered by the cargo insurance. The correct answer is D. Freight insurance protects the shipowner's anticipated earnings from carrying the cargo, which are lost if the voyage is interrupted by a peril covered by the hull insurance, and also protects the cargo owner's prepaid freight if the cargo is lost due to a peril covered by the cargo insurance. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of how different insurance policies interact, specifically freight insurance in relation to hull and cargo coverage. The challenge lies in identifying the precise role and value of freight insurance when the primary risks to the vessel, hull, and its contents, cargo, are already insured. Misunderstanding this interrelationship can lead to inadequate coverage for the insured party, potentially resulting in significant financial loss that was not anticipated. Careful judgment is required to distinguish between direct loss to physical assets and consequential financial losses related to the carriage of goods. The correct approach is to recognize that freight insurance is designed to protect the insured's right to receive freight charges, or the freight charges themselves, which are contingent upon the successful delivery of the cargo. It complements hull insurance by covering the potential loss of freight revenue if the voyage is interrupted due to a peril covered by the hull policy, e.g., a casualty to the vessel. It also complements cargo insurance by covering the freight charges paid by the cargo owner, which would be lost if the cargo is damaged or lost due to a peril covered by the cargo policy. This approach aligns with the principles of indemnity, ensuring that the insured is compensated for their financial interest in the freight. Under typical ocean marine insurance principles, freight is considered a distinct insurable interest. An incorrect approach would be to assume that hull and cargo insurance inherently cover the loss of freight. Hull insurance primarily covers damage to the vessel itself, and while a casualty might lead to loss of freight, the freight itself is not the subject of the hull policy. Similarly, cargo insurance covers the loss or damage to the goods being transported, not the freight charges associated with their carriage. Failing to recognize this distinction means overlooking a specific financial interest that requires separate protection. This leads to a failure in providing comprehensive insurance advice and potentially leaving the client exposed to uninsured losses, which is contrary to the ethical duty to ensure adequate coverage. Another incorrect approach would be to dismiss freight insurance as redundant because hull and cargo are insured. This overlooks the fact that freight is a financial interest separate from the physical assets. The insured might be the shipowner who expects to earn freight, or the cargo owner who has paid freight in advance and would lose that payment if the cargo doesn't arrive. Neither hull nor cargo insurance directly compensates for the loss of the freight revenue or the prepaid freight. This demonstrates a lack of understanding of the distinct insurable interests within an ocean marine venture. A third incorrect approach would be to consider freight insurance as a form of business interruption insurance. While there are similarities in that it covers a loss of anticipated revenue, freight insurance is specifically tied to the carriage of goods and the perils of the sea. Business interruption insurance is typically broader and covers loss of profits and ongoing expenses due to damage to the insured's business premises or operations, not specifically the freight charges for a particular voyage. Confusing these distinct coverages leads to misapplication of insurance principles and potentially inappropriate policy recommendations. The professional decision-making process for similar situations should involve a thorough assessment of all insurable interests related to a marine venture. This includes not only the vessel and its cargo, but also the freight itself, as well as potential liabilities. Understanding the specific financial stakes of each party involved, shipowner, charterer, cargo owner, is crucial. Professionals should then identify the relevant insurance policies that cover these interests and critically evaluate any potential gaps. When a specific financial interest, like freight, is not adequately covered by existing policies, recommending appropriate specialized insurance, such as freight insurance, is a key part of providing sound and ethical advice. This requires a deep understanding of the interrelationships between different types of marine insurance and their respective scopes of coverage. Question 10. The efficiency study reveals that a marine cargo insurance policy was issued to a shipping company for a consignment of electronics. Post-claim, it was discovered that the assured failed to disclose that the vessel carrying the cargo had a history of minor engine issues, which were not considered significant enough by the assured to warrant mention, but which the underwriter later argues would have influenced their decision to accept the risk or the premium charged. What is the most appropriate course of action for the insurer, considering the principles of utmost good faith and the potential materiality of the undisclosed information? Option A. Accept the claim in full, as the engine issues were minor and did not directly cause the loss. Option B. Investigate the materiality of the undisclosed engine history and the assured's knowledge and intent regarding its disclosure before making a decision on the claim or policy validity. Option C. Retroactively adjust the premium based on the historical engine issues without further investigation. Option D. Immediately void the policy ab initio due to the assured's failure to disclose a material fact. The correct answer is D. Immediately void the policy ab initio due to the assured's failure to disclose a material fact. Explanation. This scenario is professionally challenging because it requires the underwriter to balance the insurer's right to accurate information with the assured's potential oversight or deliberate omission, all within the strict confines of ocean marine insurance law. The underwriter must meticulously assess the materiality of the undisclosed information and its impact on the risk assessment at the time the policy was issued. The core difficulty lies in determining whether the concealment or misrepresentation was innocent, negligent, or fraudulent, as each has distinct legal consequences. The correct approach involves a thorough investigation into the nature of the undisclosed information and the circumstances surrounding its omission. This requires the underwriter to ascertain if the undisclosed fact was material to the risk and if the assured knew or ought to have known of its materiality. If the undisclosed information is found to be material and was deliberately concealed or misrepresented with intent to deceive, the insurer may be entitled to void the policy ab initio. If the misrepresentation or concealment was innocent or negligent but material, the insurer may have grounds to avoid liability for claims arising from the undisclosed risk, or potentially void the policy depending on the specific policy terms and governing law. This aligns with the fundamental principle of utmost good faith, uberrimi fidei, inherent in marine insurance contracts, which mandates full disclosure of all material facts by both parties. The Marine Insurance Act 1906, as applicable in the UK jurisdiction for this exam, is the primary regulatory framework governing this principle. Section 17 of the Act states that the policy is a contract based upon the utmost good faith, and if the utmost good faith be not observed by either party, the contract may be avoided by the other party. Section 18 further elaborates on the duty of disclosure, requiring the assured to disclose every material circumstance which is known or presumed to be known to him, and to state every circumstance which would influence the mind of a prudent insurer in fixing the premium, or determining whether he will take the risk. An incorrect approach would be to automatically void the policy solely based on the discovery of any undisclosed information, without first assessing its materiality and the assured's intent. This fails to uphold the principle of proportionality and could unjustly penalize the assured for minor or unintentional omissions. Such an action would violate the spirit of utmost good faith by not allowing for innocent or negligent misrepresentations to be handled appropriately, potentially leading to a breach of contract if the policy terms do not grant such broad discretion. Another incorrect approach would be to accept the claim without question, even if the undisclosed information is clearly material and demonstrably impacted the insurer's risk assessment. This ignores the insurer's right to rely on accurate information provided by the assured and undermines the principle of utmost good faith from the insurer's perspective. It also sets a dangerous precedent, potentially encouraging future lack of disclosure. A third incorrect approach would be to unilaterally alter the policy terms or premium retrospectively without proper investigation and agreement, or to deny a claim based on a minor, non-material omission. This bypasses the established legal and contractual procedures for handling misrepresentation and concealment, potentially leading to disputes and legal challenges. The professional decision-making process for similar situations should involve a systematic review of the policy, the declaration made by the assured, and the newly discovered information. This should be followed by a factual investigation to determine the materiality of the undisclosed information and the assured state of mind, innocent, negligent, or fraudulent. Legal counsel should be consulted if the situation is complex or involves significant financial implications. The insurer must then communicate their findings and proposed course of action to the assured clearly and in accordance with the policy terms and governing law, ensuring fairness and adherence to the principle of utmost good faith. Question 11. Stakeholder feedback indicates a common point of confusion regarding the application of exclusions in ocean marine insurance policies. A vessel owner has insured their cargo under an Institute Cargo Clauses policy. The vessel was chartered to a third-party charterer, who subsequently became insolvent before paying the full freight due to the vessel owner. The cargo was delivered safely, but the vessel owner has lost the freight income. The vessel owner is now claiming this lost freight income from their cargo insurer, arguing that the insolvency of the charterer caused the loss. Based on standard U.S. maritime insurance principles and common policy wordings, how should the cargo insurer assess this claim? Option A. The cargo insurer should deny the claim, as the loss of freight due to the charterer's insolvency is typically excluded under standard marine insurance policy wordings, which cover direct physical loss or damage to the insured cargo, not consequential financial losses or third-party credit risks. Option B. The cargo insurer should offer a partial settlement for the lost freight, considering the unfortunate circumstances of the charterer's insolvency and the impact on the vessel owner. Option C. The cargo insurer should cover the lost freight, as the vessel owner has suffered a financial loss directly related to the carriage of the insured cargo. Option D. The cargo insurer should investigate whether the delay caused by the charterer's financial difficulties led to any physical damage to the cargo, and if so, cover the lost freight as a consequential loss. The correct answer is A. The cargo insurer should deny the claim, as the loss of freight due to the charterer's insolvency is typically excluded under standard marine insurance policy wordings, which cover direct physical loss or damage to the insured cargo, not consequential financial losses or third-party credit risks. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of marine insurance policy wordings, specifically concerning exclusions related to consequential losses arising from delays and the financial stability of third parties. The underwriter must distinguish between direct physical loss or damage to the insured vessel or cargo, which is typically covered, and losses that are a consequence of other events, such as a charterer's insolvency, leading to non-payment of freight. The challenge lies in accurately applying the Institute Cargo Clauses, IC, and Institute Time Clauses, IC, or equivalent U.S. maritime law principles, which often have specific exclusions for such indirect losses. The correct approach involves a thorough review of the policy's exclusion clauses. Specifically, the underwriter must determine if the loss of freight falls under an exclusion for delay or for the insolvency of a third party. Standard marine insurance policies, particularly under the Institute Cargo Clauses, e.g., Clause 11 unseaworthiness and Institute Time Clauses, e.g., Clause 12 delay, often exclude losses caused by delay unless the delay is a direct result of a peril insured against. Similarly, losses arising from the insolvency or default of a charterer, leading to non-payment of freight, are typically not covered as they are considered financial or credit risks, not perils of the sea. Therefore, denying coverage for the lost freight due to the charterer's insolvency, citing the relevant exclusion clauses, is the professionally sound and compliant action. This aligns with the principle that marine insurance covers fortuitous physical losses, not commercial risks or consequential financial losses stemming from third-party default. An incorrect approach would be to assume coverage for the lost freight simply because the vessel was delayed or the charterer became insolvent. This fails to recognize the specific exclusions within marine insurance policies designed to limit coverage to direct physical losses. Covering the lost freight in this scenario would represent an expansion of coverage beyond the agreed terms and would expose the underwriter to risks that were explicitly excluded and for which no premium was charged. This would be a regulatory failure, as it deviates from the contractual obligations and established principles of marine insurance underwriting. Another incorrect approach would be to offer a partial settlement based on a subjective assessment of fairness, without reference to the policy terms. This introduces an element of arbitrary decision-making and undermines the contractual basis of the insurance, potentially leading to disputes and a breach of regulatory expectations regarding consistent application of policy terms. The professional decision-making process for similar situations should begin with a meticulous examination of the insurance policy wording, paying close attention to all exclusion clauses. The underwriter must then assess whether the claimed loss directly results from an insured peril or is a consequence of an excluded event, such as delay or third-party insolvency. If the loss appears to fall within an exclusion, the underwriter should clearly communicate this to the insured, referencing the specific policy clauses. In cases of ambiguity, seeking legal counsel or consulting with senior underwriting colleagues is advisable to ensure compliance with regulatory requirements and to maintain the integrity of the underwriting process. Question 12. The control framework reveals that a cargo owner has suffered significant losses due to a collision involving a vessel insured by a P&I club. The vessel owner, the insured party, has subsequently declared bankruptcy and is unable to satisfy the cargo owner's claim. Under U.S. maritime law, what is the most appropriate course of action for the cargo owner to pursue recovery directly from the P&I club? Option A. The cargo owner should file a claim with the P&I club as a general creditor of the bankrupt vessel owner, awaiting distribution of assets. Option B. The cargo owner must first exhaust all legal remedies against the bankrupt vessel owner before considering any action against the P&I club. Option C. The cargo owner can initiate a direct action against the P&I club because the P&I club insured the vessel owner and the vessel owner is bankrupt. Option D. The cargo owner can initiate a direct action against the P&I club, provided that a specific U.S. federal statute or relevant state law permits such an action under these circumstances of the insured's insolvency. The correct answer is C. The cargo owner can initiate a direct action against the P&I club because the P&I club insured the vessel owner and the vessel owner is bankrupt. Explanation. The control framework reveals that understanding direct action statutes is crucial for marine insurance professionals, particularly when dealing with claims against protection and indemnity, P&I clubs. The professional challenge lies in navigating the specific jurisdictional requirements that permit a claimant to bypass the insured shipowner and sue the P&I club directly. This requires a precise understanding of when such direct action is legally permissible, as P&I clubs are typically contractual insurers of their members, not directly liable to third parties unless specific statutory conditions are met. The correct approach involves identifying a situation where a direct action statute, as defined by the relevant jurisdiction, in this case, U.S. maritime law, explicitly grants a third-party claimant the right to sue the P&I Club directly. This typically occurs when the insured vessel owner is insolvent or bankrupt, and the statute is designed to provide recourse to injured parties who would otherwise be left without compensation. The regulatory justification stems from statutes like the U.S. Maritime Lien Act or similar provisions that create a cause of action against the insurer under specific circumstances, ensuring that victims of maritime negligence have a viable avenue for recovery. An incorrect approach would be to assume direct action is always possible simply because a P&I Club is involved. This fails to recognize that P&I Club coverage is primarily contractual and that direct action is an exception, not the rule. Another incorrect approach is to rely on general principles of insurance law without considering the specific nuances of maritime law and direct action statutes. This overlooks the unique legal landscape of ocean marine insurance, where specific legislation dictates the rights of claimants against insurers. A further incorrect approach would be to initiate direct action based solely on the existence of a claim against a vessel owner, without first verifying the insolvency or bankruptcy of the insured and the applicability of a direct action statute. This bypasses essential legal prerequisites and exposes the claimant to immediate dismissal of their suit. Professionals should employ a decision-making framework that begins with a thorough review of the claimant's legal standing and the financial status of the insured. This involves researching applicable direct action statutes within the relevant jurisdiction, confirming the specific conditions under which direct action is permitted, and then proceeding with legal action against the P&I Club only if those conditions are demonstrably met. Question 13. The risk matrix shows an increased likelihood of maritime incidents in a specific shipping lane due to heightened geopolitical tensions. A vessel operating in this lane experiences a seizure of its cargo by individuals who board the ship, disarm the crew, and demand ransom for the cargo's release. The individuals are not acting on behalf of any recognized state or military force, and their primary motivation appears to be financial gain through the illicit sale of the cargo. The insurance policy in question is an ocean marine cargo policy. Which of the following approaches best reflects the professional assessment of coverage under the policy's piracy exclusion? Option A. Deny the claim solely based on the fact that the cargo was unlawfully seized and detained, as this constitutes a loss of property. Option B. Investigate whether the seizure and detention of the cargo meets the specific definition of piracy as outlined in the policy's exclusion clause, considering the perpetrator's intent and lack of state affiliation. Option C. Offer coverage under the policy without a detailed review of the piracy exclusion, as any act of forceful seizure of cargo in a high-risk area should be considered a covered peril. Option D. Assume the incident is covered under a war risks clause, as geopolitical tensions are cited as a contributing factor, and therefore the piracy exclusion is not applicable. The correct answer is A. Deny the claim solely based on the fact that the cargo was unlawfully seized and detained, as this constitutes a loss of property. Explanation. This scenario presents a professional challenge because it requires the underwriter to accurately assess and apply policy exclusions in the context of evolving geopolitical risks and their impact on maritime trade. The challenge lies in distinguishing between acts of piracy, which are typically excluded, and other forms of political violence or seizure that might be covered under different clauses or endorsements. Misinterpreting the exclusion could lead to significant financial losses for the insurer and potential disputes with the insured. Careful judgment is required to interpret the specific wording of the piracy exclusion in relation to the factual circumstances of the incident. The correct approach involves a thorough review of the specific policy wording, particularly the definition and scope of the piracy exclusion. This approach is right because it adheres strictly to the contractual agreement between the insurer and the insured, which is the foundation of insurance law. Regulatory frameworks, such as those governing insurance contracts, mandate that policy terms and conditions be interpreted as written. In the context of ocean marine insurance, the Institute Cargo Clauses IC, or similar hull clauses, often define piracy and specify its exclusion. A professional underwriter must ascertain if the incident, as described, unequivocally falls within the policy's definition of piracy, considering factors like the intent of the perpetrators, the nature of the act, e.g., robbery, detention for ransom, and whether it was carried out for private ends rather than by a state actor for political reasons. This meticulous examination ensures compliance with the policy's contractual obligations and avoids arbitrary denial of claims. An incorrect approach would be to broadly interpret the piracy exclusion to encompass any act of unlawful seizure or detention of a vessel or cargo, regardless of the perpetrator's motives or the specific circumstances. This fails to acknowledge that other perils, such as war risks or strikes, riots and civil commotions, SR and CC, may have separate coverage provisions or exclusions. Applying the piracy exclusion too broadly could lead to the denial of a claim that should rightfully be covered under a different policy section, violating the principle of good faith and fair dealing expected of insurers. Another incorrect approach would be to assume coverage simply because the incident involved a loss of cargo or vessel, without critically examining the specific exclusion. This demonstrates a lack of due diligence and a failure to apply the policy's terms and conditions rigorously. It risks creating an expectation of coverage that is not contractually supported, leading to potential regulatory scrutiny for misrepresentation or unfair claims handling practices. A further incorrect approach would be to rely on general industry knowledge or anecdotal evidence about piracy, without consulting the specific policy wording and relevant case law or regulatory guidance pertaining to the interpretation of such exclusions. This can lead to inconsistent application of policy terms and a failure to meet the insurer's obligations under the law. The professional decision-making process for similar situations should involve a systematic approach. 1. Policy review. Obtain and meticulously review the relevant insurance policy, including all endorsements and clauses. 2. Factual investigation. Gather all available facts and evidence pertaining to the incident, ensuring accuracy and completeness. 3. Exclusion analysis. Carefully compare the facts of the incident against the precise wording of the piracy exclusion, considering any defined terms within the policy. 4. Coverage determination. Based on the policy wording and factual findings, determine if the incident clearly falls within the scope of the piracy exclusion. If there is ambiguity, consider other relevant clauses or endorsements. 5. Consultation. If necessary, consult with legal counsel or senior underwriting expertise to ensure accurate interpretation and application of the policy. 6. Communication. Clearly communicate the coverage decision to the insured, providing a detailed explanation based on the policy terms and the investigation findings. Question 14. The performance metrics show a significant increase in claims related to geopolitical instability. An underwriter is reviewing an ocean marine policy that contains an automatic termination clause triggered by the outbreak of war. The insured's vessel is currently operating in a region where hostilities have recently escalated, with reports of armed conflict. The underwriter must determine if the policy coverage has automatically ceased. Which of the following actions best represents the appropriate response? Option A. Continue coverage as normal, pending a formal declaration of war by a recognized authority, and monitor the situation. Option B. Immediately terminate coverage based on media reports of escalating hostilities in the region. Option C. Conduct a thorough review of the policy's automatic termination clause. Verify the factual circumstances of the hostilities through reliable sources, and assess if the specific conditions for termination have been met before communicating any decision to the insured. Option D. Advise the insured that coverage is likely terminated due to the conflict and request they seek alternative insurance immediately. The correct answer is B. Immediately terminate coverage based on media reports of escalating hostilities in the region. Explanation. Scenario analysis. This scenario is professionally challenging because it requires the underwriter to interpret a specific clause within an ocean marine insurance policy in the context of a rapidly evolving geopolitical event. The automatic termination clause upon the outbreak of war is a critical risk management tool, but its precise trigger and application can be ambiguous. The underwriter must balance the contractual obligations to the insured with the insurer's need to manage exposure to catastrophic risk, all while adhering strictly to the policy's terms and relevant regulatory frameworks. The challenge lies in making a timely and accurate determination of whether the conditions for automatic termination have been met, preventing potential coverage disputes and financial losses. Correct approach analysis. The correct approach involves a meticulous review of the policy wording, specifically the automatic termination clause, and a thorough investigation of the factual circumstances surrounding the alleged outbreak of war. This includes consulting reliable sources to confirm the existence and scope of hostilities, and assessing whether these hostilities directly impact the insured vessel or its voyage as defined by the policy. The underwriter must then apply the policy's specific language to these facts. If the clause is triggered, the underwriter must promptly and clearly communicate the termination of coverage to the insured, providing the necessary documentation and referencing the specific policy provision. This approach is correct because it upholds the contractual agreement, adheres to the principle of utmost good faith, and complies with the regulatory requirement to administer claims and policies in accordance with their terms and conditions. Incorrect approaches analysis. One incorrect approach would be to assume termination based on media reports alone without independent verification. This fails to meet the standard of due diligence required by the policy and regulatory bodies. It could lead to wrongful termination of coverage, exposing the insurer to legal action and reputational damage, and violating the duty of care owed to the insured. Another incorrect approach would be to continue coverage indefinitely, hoping the situation resolves itself, without formally assessing the termination clause. This exposes the insurer to significant uninsured risk if war is indeed declared, and the clause is triggered. It also demonstrates a failure to proactively manage risk and adhere to policy terms, potentially leading to regulatory scrutiny for inadequate policy administration. A third incorrect approach would be to unilaterally interpret the clause in a manner that favors the insurer without considering the insured's reasonable expectations or the factual context. This could involve a narrow or overly broad interpretation of outbreak of war or its impact, leading to disputes and potential bad faith claims. Regulatory frameworks emphasize fair dealing with policyholders, and such an approach would likely contravene these principles. Professional reasoning. Professionals should approach such situations by establishing a clear process for evaluating policy clauses against factual events. This involves 1. Understanding the specific policy language and its implications. 2. Gathering objective and verifiable evidence. 3. Applying the policy terms to the evidence consistently and fairly. 4. Communicating decisions clearly and promptly to all parties. 5. Consulting legal counsel or senior management when ambiguity exists. This systematic approach ensures compliance, fairness, and effective risk management. Question 15. Market research demonstrates that while certain exclusions are common in ocean marine insurance policies, their application can be contentious. Consider a scenario where a shipment of electronic goods experiences damage during transit. The insurer is considering denying the claim based on several potential exclusions. Which of the following approaches best reflects the proper application of these exclusions under the regulatory framework for ocean marine insurance? Option A. Deny the claim outright if any evidence suggests the packaging was not perfect, if some minor leakage occurred, if the goods showed any sign of deterioration, or if the voyage experienced any deviation from the planned schedule. Option B. Conclude that any loss occurring during a delayed voyage is a result of the delay itself and is therefore excluded, regardless of the specific nature of the damage sustained. Option C. Investigate whether the damage was proximately caused by a defect in the packing that rendered it unfit for the voyage, whether the leakage was extraordinary and not a natural consequence of the voyage, whether the deterioration was due to the inherent nature of the goods rather than external perils, and whether any delay directly led to a covered peril or was itself a specifically excluded cause of loss. Option D. Assume that any damage to electronic goods during transit is due to improper packing, and therefore automatically deny coverage without further investigation. The correct answer is A. Deny the claim outright if any evidence suggests the packaging was not perfect, if some minor leakage occurred, if the goods showed any sign of deterioration, or if the voyage experienced any deviation from the planned schedule. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of marine insurance exclusions, specifically distinguishing between events that are truly excluded and those that may be covered despite initial appearances. The challenge lies in applying the specific wording of the policy and relevant regulatory interpretations to factual circumstances, avoiding oversimplification or misapplication of exclusion clauses. Careful judgment is required to ensure fair claims handling and adherence to the principles of utmost good faith. The correct approach involves a thorough examination of the policy wording and the specific facts of the loss, considering the interplay between different exclusion clauses. It recognizes that exclusions are to be interpreted narrowly and that the burden of proof for establishing an exclusion typically rests with the insurer. This approach prioritizes a fact-specific analysis, seeking to understand the proximate cause of the loss and whether it falls squarely within the defined exclusions, such as improper packing, ordinary leakage, inherent vice, or delay, as interpreted under the applicable regulatory framework for ocean marine insurance. This aligns with the regulatory expectation of fair claims handling and the contractual obligations of the insurer. An incorrect approach that broadly applies the improper packing exclusion without investigating the extent to which the packing was deficient and whether this deficiency was the direct cause of the loss fails to consider that some degree of minor damage might be expected and not necessarily constitute improper packing in a way that voids coverage. Similarly, an approach that automatically denies claims for any ordinary leakage, without assessing whether the leakage was truly ordinary and unavoidable or indicative of a defect in the packaging or vessel, ignores the principle that insurers cover perils of the sea, which can include some degree of expected leakage. Dismissing a claim solely based on inherent vice, without demonstrating that the goods themselves possessed a defect that would cause them to deteriorate or be damaged, irrespective of external causes, misinterprets this exclusion, which is meant for self-inflicted damage. Finally, an approach that denies coverage for any loss occurring during a delay, without establishing that the delay itself was the proximate cause of the loss, or that the policy contained a specific exclusion for losses arising from delay, overlooks the fact that delay alone is not always an exclusion unless it directly leads to a covered peril or is specifically excluded. These incorrect approaches fail to uphold the principles of fair claims settlement and may breach regulatory requirements by improperly denying valid claims. Professional decision-making in such situations requires a systematic process. First, meticulously review the insurance policy, paying close attention to the specific wording of the exclusions in question. Second, gather all relevant facts and evidence pertaining to the loss, including surveys, expert reports, and witness statements. Third, analyze the proximate cause of the loss, determining which event or condition was the dominant and efficient cause. Fourth, compare the factual findings with the policy exclusions, applying a narrow interpretation of any exclusion. Fifth, consult with legal counsel or claims specialists if the interpretation is complex or contentious. Finally, communicate the decision clearly and transparently to the insured, providing detailed reasons for acceptance or denial of the claim, supported by policy provisions and factual findings. Question 16. Strategic planning requires a thorough understanding of the principles governing ocean marine insurance claims, particularly when dealing with incidents that may involve general average. Consider a scenario where a vessel carrying multiple cargo interests encounters a severe storm, forcing the master to jettison a portion of the cargo to lighten the ship and prevent further damage to the remaining cargo and the vessel itself. Subsequently, the shipowner incurs significant expenses for salvage operations to bring the vessel and the remaining cargo to a safe port. Under the York-Antwerp rules, how should the jettisoned cargo and the salvage expenses be assessed in relation to the common maritime adventure and the potential claims under an ocean marine insurance policy? Option A. The jettisoned cargo is a general average sacrifice, and the salvage expenses are also general average expenses, both to be contributed to by all interests of the common maritime adventure, including the insured cargo, freight, and vessel. Option B. The jettisoned cargo is a particular average loss, and the salvage expenses are a general average expense to be contributed to by all interests of the common maritime adventure. Option C. The jettisoned cargo is a particular average loss for the owner of that cargo, and the salvage expenses are solely the responsibility of the shipowner, with no contribution from the insured cargo. Option D. The jettisoned cargo is a general average sacrifice, but the salvage expenses are considered operational costs of the shipowner and are not subject to general average contribution. Correct answer is A. The jettisoned cargo is a general average sacrifice, and the salvage expenses are also general average expenses, both to be contributed to by all interests of the common maritime adventure, including the insured cargo, freight, and vessel. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of the York-Antwerp rules and the concept of a common maritime adventure, specifically within the context of ocean marine insurance. The challenge lies in correctly identifying which expenses qualify as general average contributions and how they impact the insured value, without overstepping the bounds of the policy's coverage or misinterpreting the fundamental principles of maritime law and insurance. Careful judgment is required to distinguish between general average sacrifices and expenses, and those that are merely particular average losses or operational costs. The correct approach involves accurately applying the principles of the York-Antwerp rules to determine if an expenditure or sacrifice constitutes a general average act. This requires recognizing that a common maritime adventure exists when multiple interests, ship, cargo, freight, are exposed to a common peril. If a sacrifice or expenditure is intentionally and reasonably made for the common safety of the adventure, it is a general average act. The subsequent adjustment under the York-Antwerp rules then dictates how the loss is shared proportionally among the contributing interests. In an insurance context, this means understanding how the insured's liability for such contributions is covered by the policy. An incorrect approach would be to assume all expenses incurred during a peril are general average. For instance, treating a shipowner's routine maintenance costs incurred during an emergency or cargo damage that is solely attributable to the cargo's own inherent vice and not a common peril, as general average contributions would be a regulatory and ethical failure. This misinterprets the core principle of intentional sacrifice or expenditure for the common safety. Another incorrect approach would be to ignore the York-Antwerp rules entirely and attempt to settle claims based on ad hoc agreements, which would violate the established legal framework governing general average and potentially lead to disputes and breaches of contract. Furthermore, failing to consider the common maritime adventure and focusing solely on individual losses would also be incorrect, as it negates the very foundation of general average. Professionals should approach such situations by first identifying the peril and whether it threatened the common maritime adventure. Then they must assess if any sacrifice or expenditure was intentionally made for the preservation of the entire adventure. If so, they should consult the relevant York-Antwerp rules to determine if the sacrifice or expenditure qualifies for general average. Finally, they must apply the principles of general average adjustment to determine the contributing values and the insured's liability, ensuring compliance with the policy terms and the governing legal framework. Question 17. Stakeholder feedback indicates a need for greater clarity on the application of specific perils within ocean marine insurance policies. A shipowner is seeking confirmation regarding coverage for their vessel against the risks of strikes, mines, torpedoes, bombs, capture, seizure, restraint, and detainment. Based on the regulatory framework and standard practices for the ocean marine insurance exam, which of the following represents the most accurate approach to advising the shipowner on the scope of coverage for these perils? Option A. Recommend that the shipowner immediately secure a separate war risks policy without first reviewing their existing hull and machinery policy for any relevant endorsements or clauses that might offer coverage for some of these perils. Option B. Explain that restraint and detainment are exclusively covered if they are a direct result of governmental action, and other listed perils are generally excluded from standard hull insurance. Option C. Inform the shipowner that all listed perils are automatically covered under a comprehensive ocean marine insurance policy, as they are inherent risks of maritime operations. Option D. Advise the shipowner that coverage for perils such as mines, torpedoes, bombs, capture, seizure, restraint, and detainment is typically excluded from standard hull and machinery policies and would require a separate institute war clauses policy. Correct answer is D. Advise the shipowner that coverage for perils such as mines, torpedoes, bombs, capture, seizure, restraint, and detainment is typically excluded from standard hull and machinery policies and would require a separate institute war clauses policy. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of the exclusions and inclusions within an ocean marine insurance policy, specifically concerning perils of war and related risks. The challenge lies in distinguishing between standard war risks, which are often excluded and covered by separate clauses or policies, and the specific perils listed in the question, which may or may not be covered depending on the policy wording and endorsements. Careful judgment is required to correctly interpret the scope of coverage without overinsuring or underinsuring the vessel. The correct approach involves a thorough review of the specific ocean marine insurance policy wording, including any endorsements or clauses related to war risks, strikes, mines, torpedoes, bombs, capture, seizure, restraint, and detainment. This approach is right because it directly addresses the policy's contractual obligations and the insured's expectations. The Marine Insurance Act 1906, as applicable in the UK jurisdiction for this exam, and Standard Institute war clauses are critical regulatory and legal frameworks that define these perils. Specifically, the Act defines perils of the seas and the general principles of marine insurance, while the Institute war clauses provide detailed coverage and exclusions for war-like perils. A correct assessment will determine if the listed perils fall under the standard hull insurance, require a specific war risks endorsement, or are entirely excluded. This aligns with the ethical duty of an insurance professional to accurately represent policy coverage and act in the best interest of the client by ensuring appropriate protection. An incorrect approach would be to assume that all listed perils are automatically covered under a standard hull policy without verification. This fails to acknowledge that war and related risks are often treated separately due to their distinct nature and higher potential for loss. This approach violates the regulatory requirement to adhere to policy terms and conditions and is ethically unsound as it misleads the insured about their coverage. Another incorrect approach would be to immediately refer the insured to a separate war risks policy without first examining the existing hull policy for any applicable clauses or endorsements that might provide partial or full coverage for some of the listed perils. While a separate war risks policy is often necessary, this approach prematurely dismisses potential coverage under the existing contract, potentially leading to unnecessary additional premiums for the insured. This demonstrates a lack of due diligence and a failure to fully explore the existing contractual framework. A third incorrect approach would be to interpret restraint and detainment solely as governmental actions, ignoring other potential causes of restraint or detainment that might be covered under different policy provisions or exclusions. This narrow interpretation can lead to an inaccurate assessment of coverage for these specific perils, which can arise from various sources beyond direct governmental action. The professional decision-making process for similar situations should involve a systematic review of the policy documents, including the Institute clauses and any endorsements. This should be followed by a clear understanding of the definitions and scope of coverage for each peril in question, referencing relevant legislation and industry standards. If ambiguity exists, seeking clarification from underwriters or legal counsel is a crucial step. The ultimate goal is to provide accurate advice that reflects the true extent of the insurance coverage. Question 18. Quality control measures reveal that a vessel insured under an ocean marine policy has run aground in a remote location. The master estimates that the grounding is minor, with no immediate signs of significant hull damage or cargo spoilage. The master decides to wait 48 hours to assess the situation more thoroughly before informing the underwriter, believing this will allow for a more accurate damage report. Which of the following actions best upholds the assured's duties under the policy? Option A. Only notify the underwriter after completing all salvage and repair operations. Option B. Assume the loss is minor and decide not to notify the underwriter until a claim is formally submitted. Option C. Delay notification for 48 hours to assess the full extent of the damage. Option D. Immediately notify the underwriter of the grounding, even before a full damage assessment is complete. The correct answer is D. Immediately notify the underwriter of the grounding, even before a full damage assessment is complete. Explanation. Scenario analysis. This scenario is professionally challenging because it requires the assured to balance their immediate need to mitigate further loss with their contractual obligation to provide prompt notice to the underwriter. Delaying notice, even with good intentions to limit damage, can prejudice the underwriter's ability to investigate and assess the claim effectively, potentially leading to disputes. The assured must exercise sound judgment in determining what constitutes prompt notice under the circumstances, considering the nature of the loss and the potential for escalation. Correct approach analysis. The correct approach involves the assured immediately notifying the underwriter of the grounding, even before a full assessment of the damage is complete. This aligns with the duty of prompt notice, a fundamental requirement in marine insurance contracts. The Marine Insurance Act 1906, as applicable in the UK jurisdiction for this exam, implies a duty on the assured to take all reasonable steps to avert or minimize a loss. Prompt notification allows the underwriter to exercise their rights, such as appointing a surveyor, advising on salvage operation, or directing the assured on necessary actions to prevent further damage or loss. This proactive communication upholds the principle of utmost good faith and ensures the underwriter is not disadvantaged by a lack of timely information. Incorrect approaches analysis. An approach where the assured delays notification for 48 hours to assess the full extent of the damage is incorrect because it violates the duty of prompt notice. While assessing damage is important, it should not come at the expense of informing the underwriter without undue delay. This delay could prejudice the underwriter's investigation and their ability to manage the claim effectively, potentially leading to a denial of coverage or a dispute over the extent of liability. An approach where the assured only notifies the underwriter after completing all salvage and repair operations is incorrect. This represents a significant breach of the duty of prompt notice. By the time of notification, the underwriter would have lost the opportunity to participate in or direct the salvage and repair efforts, potentially incurring costs that they might have otherwise avoided or managed differently. This failure to provide timely notice fundamentally undermines the underwriter's position and the principles of marine insurance. An approach where the assured assumes the loss is minor and decides not to notify the underwriter until a claim is formally submitted is incorrect. The assured's subjective assessment of the loss's magnitude is not a substitute for prompt notification. Even minor incidents can escalate, and the underwriter has a right to be informed of any event that could potentially lead to a claim, regardless of the assured's initial assessment. This approach neglects the proactive duty to inform and could lead to the underwriter being blindsided by a claim that could have been managed more effectively with earlier communication. Professional reasoning. Professionals should adopt a decision-making framework that prioritizes immediate communication of any material event that could lead to a claim. This involves understanding the contractual obligations regarding notice, assessing the potential impact of the event, and erring on the side of caution by notifying the underwriter promptly, even if the full extent of the loss is not yet known. The professional should document all communications and actions taken. In situations of uncertainty about what constitutes prompt, seeking clarification from the underwriter or their representative is advisable. Question 19. The monitoring system demonstrates that following a severe storm, the vessel jettisoned a portion of its cargo to ensure the common safety of the ship and the remaining cargo. The average adjuster is tasked with determining the general average contributions. Which of the following best describes the adjuster's primary regulatory and ethical obligation in this situation under UK maritime insurance law? Option A. Meticulously identify the sacrifices and extraordinary expenditures made for the common safety, and then determine the contributory values of the ship, freight, and cargo to equitably apportion the loss according to the Marine Insurance Act 1906 and the York-Antwerp rules. Option B. To prioritize the recovery of the maximum possible contribution from the cargo insurers, as they bear the primary financial risk for cargo losses. Option C. To calculate the general average contribution based solely on the insured value of the jettisoned cargo, as this represents the direct loss to the cargo owner. Option D. To adjust the general average contribution based on the market value of the cargo at the port of loading, as this reflects the initial investment. The correct answer is C. To calculate the general average contribution based solely on the insured value of the jettisoned cargo, as this represents the direct loss to the cargo owner. Explanation. This scenario is professionally challenging because it requires the average adjuster to navigate complex legal and contractual obligations under the Marine Insurance Act 1906, MIA 1906, and the York-Antwerp rules YAR, without resorting to simplistic or self-serving interpretations. The core difficulty lies in accurately determining the scope of general average and the subsequent apportionment of contribution, which directly impacts the financial liabilities of various parties to the adventure. The adjuster must act with impartiality and a thorough understanding of the principles of indemnity and contribution as enshrined in UK maritime law and insurance practice. The correct approach involves a meticulous application of the principles of general average as defined in the MIA 1906, specifically Section 66, and the relevant provisions of the YAR. This means identifying sacrifices and extraordinary expenditures intentionally and reasonably made for the common safety of the ship and cargo. The adjuster must then calculate the contributory values of the ship, freight, and cargo, ensuring these are assessed on a sound market value basis, less any charges that would have been incurred had the cargo arrived safely. The subsequent apportionment of the general average loss amongst these contributory values, reflecting each party's share of the common benefit derived from the sacrifice or expenditure, is crucial. This methodical and legally compliant process ensures fairness and upholds the contractual obligations of the insurers and assureds. An incorrect approach that focuses solely on the insured value of the cargo without considering its sound market value at destination, or the contributory value of the ship and freight, fails to adhere to the fundamental principles of general average. This would violate Section 66(2) of the MIA 1906, which mandates that general average losses are adjusted according to the sacrificed or extraordinary expenditure and the contributory values of the property involved. Similarly, an approach that prioritizes the recovery of the maximum possible contribution from the cargo insurers without a proper assessment of the ship's and freight's contributory values would be a breach of the adjuster's duty of impartiality and adherence to the YAR. This misrepresents the true extent of the common danger and the equitable distribution of the loss. Another incorrect approach might involve applying a simplified calculation based on the insured value of the cargo alone, ignoring the fact that general average contributions are based on the actual contributory values of all interests at risk, not just the insured amounts. This disregards the established legal framework for general average adjustment. Professionals should employ a decision-making framework that begins with a thorough understanding of the casualty and the actions taken. This involves consulting the relevant policy wording, the MIA 1906, and the applicable YAR. The adjuster must then gather all necessary documentation, including ship's logs, captain's protests, and cargo manifests, to establish the facts. The calculation of contributory values and the apportionment of losses must be performed with precision, ensuring transparency and providing clear justification for each step. Regular communication with all involved parties, including shipowners, cargo owners, and insurers, is essential to manage expectations and facilitate a smooth adjustment process. Question 20. System analysis indicates that a vessel insured under an ocean marine policy has suffered a total loss. The policy specifies valuation based on invoice value, freight, and insurance. The insured claims that the anticipated profit from the voyage, which was demonstrably in progress and commercially viable, should also be included in the settlement for the total loss. Considering the principles of ocean marine insurance valuation, which approach best reflects the insurer's obligation. Option A. Settle the claim based on the invoice value, freight, and insurance, but exclude any anticipated profit as it is speculative. Option B. Settle the claim based solely on the invoice value of the vessel, as this represents the direct cost of acquisition. Option C. Settle the claim based on the invoice value of the vessel, plus the cost of freight and insurance, and a reasonable estimation of the anticipated profit. Option D. Settle the claim based on the invoice value, freight, and insurance, but deduct a betterment allowance for the vessel's presumed improved condition had it completed the voyage. Correct answer is C. Settle the claim based on the invoice value of the vessel, plus the cost of freight and insurance, and a reasonable estimation of the anticipated profit. Explanation. This scenario is professionally challenging because determining the correct valuation for a total loss of a vessel under an ocean marine insurance policy requires a precise understanding of the policy's terms and relevant legal frameworks, particularly concerning the inclusion of anticipated profit. Misinterpreting valuation can lead to significant financial disputes between the insured and the insurer, impacting the insurer's solvency and the insured's ability to recover their full loss. Careful judgment is required to balance the principle of indemnity with the contractual obligations of the policy. The correct approach involves valuing the loss at the invoice value of the vessel, plus the cost of freight and insurance, and crucially, any anticipated profit that the insured would have realized had the voyage been completed. This aligns with the principle of placing the insured in the same financial position they would have been in had the loss not occurred. Under typical ocean marine insurance principles, particularly those reflected in standard clauses and common law interpretations within the specified jurisdiction, anticipated profit is often considered a legitimate element of loss when it is reasonably ascertainable and was in contemplation at the time the insurance was effected. This is because the profit represents a financial benefit the insured would have undeniably received, but for the casualty. An incorrect approach would be to value the loss solely at the invoice value, excluding freight, insurance, and anticipated profit. This fails to indemnify the insured for all costs incurred and benefits lost in bringing the vessel to its destination and realizing its intended commercial purpose. It also ignores the potential for profit, which is a core element of the commercial venture being insured. Another incorrect approach would be to include speculative or unproven profits. While anticipated profit is generally recoverable, it must be reasonably ascertainable and not based on mere conjecture. Including profits that are highly uncertain or not demonstrably in the offing would violate the principle of indemnity by overcompensating the insured. A further incorrect approach would be to deduct a betterment without clear policy provisions or legal justification. Betterment typically applies when a repair or replacement makes the insured item superior to its pre-loss condition. In a total loss scenario, the focus is on the value of the lost item, and the concept of betterment is generally not applicable in the same way as it is for partial losses or repairs, unless specifically defined in the policy to reduce the payout based on a hypothetical improved state. The professional decision-making process for similar situations should involve a thorough review of the specific policy wording, including any endorsements or clauses that define valuation in the event of a total loss. This should be followed by an examination of relevant case law and regulatory guidance within the specified jurisdiction concerning the recoverability of freight, insurance costs, and anticipated profits. The insured should be consulted to provide evidence supporting the anticipated profit, such as contracts, market analysis, or historical performance. The insurer must then apply these findings objectively to arrive at a fair and legally compliant valuation, ensuring that the insured is fully indemnified without being unjustly enriched.